Stop. If you're a high earner, you have probably heard that the Backdoor Roth IRA is your golden ticket to tax free wealth. Every finance guru, blog, and podcast seems to repeat the same thing. If you make too much money for a regular Roth IRA, just use the backdoor. They sell it as a simple, clever, and perfectly legal tax workaround to bypass the government's income limits. But here's what they often leave out: it's not that simple for everyone. The way the backdoor Roth IRA is commonly taught to the masses can be dangerously oversimplified. You have been sold a tax free dream, but you might not have been told about the financial landmine that could blow up your entire strategy. Many high earners are flocking to this strategy, but some are unknowingly setting themselves up for a huge unexpected tax bill. And in this video, I'm going to expose the critical flaw in the backdoor Roth IRA that the gurus conveniently forget to mention. And more importantly, I'm also going to show you an alternative that is often discussed for tax free wealth and will break down its own set of pros and cons. What I'm about to share is the information you need to make a truly informed decision. So, what's this big omission? The idea that the backdoor Roth IRA is a simple two-step process for everyone. The story goes that you can just contribute to a traditional IRA and immediately convert it to a Roth, magically sidestepping taxes without any consequences. This oversimplification isn't just misleading. For some people, it's dangerous. There's a ticking time bomb hidden in the tax code that many people don't discover until it's way too late. Let's deconstruct this piece by piece. The number one reason the backdoor Roth IRA can backfire for so many people is a single devastating regulation called the pro rata rule. Here's how the dream is sold. Step 1: make a non deductible, that is, after tax contribution to a traditional IRA. For 2025, that's up to $7,000 or $8,000 if you're 50 or older. Since you're a high earner, you cannot deduct this contribution, which is fine. Step 2: you immediately convert that traditional IRA to a Roth IRA. And since you already paid taxes on the money, the conversion should be tax free. Simple, right? Wrong. This only works if you have exactly $0 in any other traditional SEP or simple IRAs. The moment you have pre tax money in any of these other IRAs, the pro rata rule kicks in and can turn this tax free move into a tax nightmare. The IRS sees all of your IRAs as one giant IRA for tax purposes. You can't just pick and choose to convert only the after tax money you just put in. The IRS forces you to take a pro rata or proportional slice of both your pre-tax and after-tax funds. Let's see a real-world example. Let's talk about Sarah. She's a high earner who's been diligently saving. A few years ago, she left a job and rolled her old 401k with $93,000 of pre-tax money into a traditional IRA. Now she hears about this backdoor Roth hack and decides to try it out. She contributes $7,000 of after tax money into a new traditional IRA. Her total IRA balance is now $100,000. Of that $100,000, only 7% or $7,000 is after tax money. The other $93,000 is pre tax money. Now, when Sarah tries to convert her 7,000 contribution to a Roth, the IRS says, hey, not so fast. Because of the pro rata rule, only 7% of her conversion, a measly $490, is tax free. The other 93%, a whopping $6,510, is now considered taxable income at her highest tax rate. Suddenly, her tax free strategy has generated a big tax bill. She was sold a simple trick but ended up in a complicated tax trap. And this isn't a rare case. It's the reality for millions of Americans with old 401k rollovers or previous tax deductible IRA contributions. For them, the backdoor Roth IRA isn't a simple hack, it's a hazard. The second oversimplification is the idea that this is a simple set it and forget it strategy. Even if you avoid the pro rata rule, the backdoor Roth process introduces a layer of paperwork that can lead to costly mistakes if you miss it. To do this correctly, you must file IRS Form 8606, non deductible IRAs. This form is how you tell the IRS that you made after tax contributions and track your basis, that is, the pot of money you have already paid taxes on. If you fail to file this form, the IRS has no record of your after tax contribution and will assume all the money in your traditional IRA is pre tax. What happens then? When you eventually withdraw that money from your Roth IRA in retirement, you could end up getting taxed on it again. You get double taxed because of a paperwork error. The gurus who preach this strategy in 60-second videos rarely emphasize the critical importance of this form. They make it sound as easy as a bank transfer, but one missed form can undo the entire tax benefit. And furthermore, you have to do this every single year you perform the backdoor strategy. It's not a one time setup, but an annual task with the IRS, which increases the chances of making an error over time. And finally, let's talk about the ghost in the tax code, the step transaction doctrine. This is a legal principle the IRS can use to invalidate a series of individual steps if it believes the sole purpose was to avoid taxes. The backdoor Roth IRA is, by definition, a series of steps to get a result the law otherwise prevents for high earners. You contribute to a traditional IRA with the clear plan of immediately converting it to a Roth. The first step exists only to enable the second. Now, to be clear, the IRS has not formally challenged properly executed backdoor Roths under this doctrine yet, and most tax professionals consider the risk to be low. However, the IRS has also never officially given it a formal blessing, which creates a slight but not zero level of ambiguity. This has led to debates among tax pros about how long you should wait between the contribution and the conversion, a day, a month. And while it's a widely used and legal strategy under current law, it's important to know it's built on a recognized workaround and not a direct path legislated by Congress. So, if the most popular tax hack for high earners has three potential traps, what are the alternatives? Before we get into that, if you're getting value out of this breakdown and want more honest financial analysis, take a moment to hit the like button and subscribe. It helps to get this information to more people who have been told an oversimplified story. Now that you know the major trap of the backdoor Roth IRA, what's a different solution high earners often hear about for tax free growth and income? The answer lies not in a clever loophole, but in a financial product designed for different goals. Index Universal Life Insurance, or IUL. Now hold on, I know insurance products are often misunderstood and frankly controversial. They can be complex and expensive. But to have a complete picture, it's worth understanding how they work and what promises they make. An IUL is a type of permanent life insurance with two parts, a death benefit and a cash value account. This cash value is where things get interesting. It can grow based on the performance of a stock market index, like say the S&P 500, but with a twist. There's usually a 0% floor, which means your cash value does not lose money in a market crash. In exchange for that safety, there's a cap on your potential gains. Here's why it's pitched as a solution. First, your cash value grows tax deferred, but the real power comes from how you can access the money. By taking loans against your cash value, which are tax free, as long as the policy stays active and is structured correctly. Let's compare this to the backdoor Roths issues. With an IUL, there is no pro rata rule, and there are no income or contribution limits set by the government. And it's also not a loophole based on a series of steps. The tax treatment for life insurance has been established in the tax code for a really, really long time. However, IULs are not simple or perfect. They are complex instruments and they need to be structured correctly if you really want to derive the value from them. And what is the value? The value is a tax free stream of retirement income. But there are costs, and the cost can be substantial if it is not structured properly. So let's summarize. The backdoor Roth IRA is sold as the ultimate tax hack for high earners, but the story is often incomplete. The pro rata rule can trigger unexpected taxes for anyone with pre existing pre tax IRA funds, making it a non starter for many. With those with no pre tax IRAs, it does remain a powerful and straightforward strategy as long as you remember to file Form 8606 each year. And the truth is that while products like a properly structured index universal life policy can offer tax free income without income limits or the pro rata rule, they are not a very simple substitute. They are complex, And they also come with high costs if not structured properly. Now you have the information the gurus sometimes leave out. You can see past the oversimplified hacks and make a truly informed decision about the best way to build your tax free wealth for the future. If you are a high earner and this has opened your eyes to the risks and trade offs of these strategies, I want to help you explore them in more detail. I've put together a guide called the Tax Free Wealth Blueprint that breaks down how tax free strategies can give you a retirement plan which is peaceful and stress free. Click the link in the description to download the free guide. Don't let your retirement plan be built on an incomplete story. Get the full picture.